Good Things with BBB helps you be a better business.
Welcome to the All Good Things with BBB podcast. I'm your host, Jessica Tharp, and today we have J.R. Runkle of Fortner Insurance to talk to you about some rapid fire questions regarding insurance, a hot topic on a lot of people's mind right now. So we're going to dive in. J.R. has been in the industry for over 30 years, BBB accredited since 1998, knows his stuff. So I guarantee you're going to learn a thing or two about insurance starting right now. So let's start with teenagers.
Yes.
What do we need to know when we're thinking about insuring a teenage driver?
So you hope they have good grades. Let's start with that. So there is starting with good grades. There's a good student discount that you have with autos. The part that kids are not going to like to hear, like I always tell parents, you buy, I say, disposable cars when they turn 16. You want to buy a liability-only car, a car that you're not worried about what happens to it, because the physical damage side, the comp and collision, gets so pricey, and you're better off having a car. Now, people then worry about safety and all of that, but the reality is that you're better off not buying a super expensive car, even though it's their Sweet 16 and they want this beautiful car. That's going to be the biggest factor, is the comp and collision from that standpoint.
And saving money because the car is older too?
Correct. That's why it's all going to keep the price down. But the other thing, every company underwrites differently. So let's just say you have 4 drivers in your household, a mother, a father, 2 children, one who's 16, one who's 20, and you have 4 vehicles. The issue is some companies will allow us as agents, when we're quoting it and when we write it, to assign the correct vehicle to the correct driver of who is really driving the vehicle. Other companies will do a blended rate where they will take all the drivers, all the vehicles, and then they blend it together. Or some companies, their underwriting philosophy is they put the most expensive driver on the most expensive car because they have the ability to at some point drive that car. You know, the dad has a fancy Porsche that he's going to use, he or she, the daughter's going to use on prom or homecoming. They're driving that vehicle. The insurance company looks at it as that is the possible exposure that they are taking, so they're going to assign it to the most expensive driver of the vehicle. So that is a huge factor when you're shopping stuff of how the companies do assign those rates to drivers.
Mm-hmm. Some questions we get asked are, should they have their own policy or do you just add them as a driver on your policy?
I would always say, as long as your child is living in your household and they're in school and they're living in your household, most of them are always going to consider them as part of a household. When a child leaves the household, is out, that's technically when we say you should put them on their own. Everybody under the age of 25, though, is going to be super pricey if they're on their own, an 18, 19-year-old. But like I said, if they're in college and they're living in the house, then they are considered part of the household. On the homeowner side, from a liability standpoint, technically you can be the 35-year-old person living in your parents' basement, and you are still covered under the liability of a homeowner's policy. There's not a cap on how old you have to be when you're living in the house and you're getting protection under a homeowner's policy.
What happens if you are in an accident with someone who is underinsured?
So you have on your policy, you would have underinsured and uninsured motorists. So you can buy that coverage and it's part of your policy. There's also what's called UMPD, which stands for Underinsured Motorist Property Damage. And so, or uninsured motorist property damage. So you can buy like $15,000 of coverage for if you get hit by an uninsured driver from that standpoint. And then also if you have your own comp and collision on your vehicle, then you would have coverage for your vehicle. Your company would be paying it. And unfortunately, there's really no one that can go back against, because if that person doesn't have insurance, the fact is they probably don't have a lot of assets to go back against. But if you carry a liability-only vehicle, you can buy the UMPD up to $15,000 to take care of damage that happens to your vehicle.
Let's talk to our really young friends and explain the difference between liability, comp, and collision.
Sure. So when you look at a vehicle, you look at 2 things that can happen. One, the vehicle could be damaged, hurt in an accident, tree falling on it, here, all kinds of stuff. So that's what we consider your comp and collision. So you have 2 different deductibles that apply. Comprehensive would be stuff like your car is in your garage, burns up in a fire, so there's damage to your vehicle. The windshield breaks, that's comprehensive. Collision is if you run into somebody or somebody runs into you, you collide. Even a shopping cart colliding with your vehicle could fall under collision. Crazy, but those are the kind of things. Then liability only is when you're buying a vehicle that you're not worried about what the cost to repair that. Like I was saying earlier, disposable cars. The first car I bought for my 24-year-old twin boys now, that when they were 16 was a $1,000 car that if it was damaged, wrecked, we didn't care, but we wanted to protect ourselves against them hitting somebody and them suing us. So that's where you just by the liability, by law, you have to have liability coverage on your policy to cover.
So
your actions on
having
your-
liability does not make you underinsured.
No. Now you could carry low policy limits. So in the state, if you were carrying something like 25, 50 limits, so 25,000 of liability, or if you would hit a $100,000 Mercedes BMW, you would not have enough money to cover that, but legally you have enough to satisfy the requirement of the state.
Okay.
That's where then the person having the expensive car would need the underinsured motorist coverage. Because they're underinsured, not uninsured, they have insurance. So again, all kinds of fun stuff.
Can you be overinsured on an auto policy?
It's hard to be overinsured. I mean, again, yeah, if you want to try to buy $2 million in liability and you're only worth, a couple $100,000, then you really probably don't need that much. The biggest thing of being underinsured or overinsured is when you look at, how much you might put on your homeowners or, more from that standpoint. It's hard on the auto side to be overinsured.
Can you talk to young people about the importance of not letting your auto insurance lapse due to non-payment?
Well, I mean, the reality is by law you have to have it. So it's a huge problem because you're going to have no coverage. You're going to be in violation. You'll be ticketed for not having insurance coverage.
I see some complaints come into our office with regard to insurance where the company may have canceled the policy and their complaint is how difficult it is to get coverage since they've been canceled.
It's a real problem right now, and we're especially seeing that more on the homeowner side. The reality is that's part of the underwriting process. Companies can choose to say, if you've had so many tickets, you've had so many accidents, whatever the case may be, we're not going to insure them. We as an independent world have companies that pretty much will give you a price. You might not like the price. I mean, I remember one time, and not kidding, a young lady, she was in her teens, had 2 or 3 accidents, and she had a life. So we were only paying liability, no physical damage to the car, and she was paying $4,000 every 6 months. So it was $8,000 a year for her parents to keep letting her drive. I can tell you, my kids would not be driving. They would not have a car. But that's just, and a lot of it really does come down to the parents and what they allow. But the insurance companies are definitely underwriting has gotten a lot tighter, and companies' technology has gotten better where they're able to determine what causes future losses, and so companies are getting way better at using more factors in their rating of auto insurance. Mm-hmm. So it's one company might have 27 factors, or someone else that might have 50 factors to rate how they determine what the probability of losses are down the road.
That's not a math problem I want to try to solve.
No, those actuarials are important people, though. They know what they're doing.
Well, we touched on homeowners insurance a little bit. Definitely a pain point for a lot of people right now with rates going up significantly. What is the importance process when talking to someone about their homeowners insurance policy? What's important? What's not important?
When we bring in somebody new, we're going through a whole process of doing a cost estimator on the house. We need to find out, numbers, bedrooms, bathrooms, square footage, all that. We do a whole analysis where our companies make us run a cost estimator on what it would cost to replace it. And there's a few companies out there that most of the companies use them. And that's the biggest piece, is because you don't want to be underinsured at the time of the loss. And so they have to look at the factors of if there's a major disaster like the Washington tornado that happened, where everybody's trying to fight for materials to try to rebuild and all that. And so a lot of people these days, one of the biggest complaints is that people want to insure the houses more than what the market value. Huge difference between market value and replacement cost of what it takes to replace. The reality is our industry is also underpriced homeowners, to be honest, over the years. There are a lot of companies they want to be auto pricing, so they make the package and they have underpriced homeowners. And so we are in a whole industry issue with all the natural disasters and everything. But I hate to say it, but property in general is going up around this country. But unfortunately, we're going to see some steady increases. Now, there's been companies that don't need to take the drastic changes because they've slowly implemented that are now becoming more competitive in the marketplace where they've been priced a little bit more competitively. But there's so many factors now that come into play, like service line coverage from your house to the street, where you'll see those ads come around, $19.95 added every month. Well, we can add that kind of stuff for maybe like $9 a year,
Yeah.
where it's coverages like that that are new. I mean, 10 years ago, that coverage didn't exist. Stuff like roofing and siding restoration matching. You know, two sides of your house is damaged by a storm, but the other ones aren't. You can't find the matching siding. You know, we add on endorsements that can add on that additional stuff. I mean, it's not just a cookie cutter, sit down and just, you can shop. I mean, people want to just shop on the internet, that's fine. And you're going to get a lack of help when it comes down to time of when you need to talk to somebody and get some answers. And so, you know, it's something that we don't want to personally, Fortner, we don't want to be in that game of just it's all about price, because we don't see it that way. I mean,
Right.
there's way more that goes in, and insurance is all about how much risk you want to take on. So do you want to carry a higher deductible? That's what a lot of companies are pushing you to carry, the higher deductibles that you know, the first $1,000 is out of your pocket, maybe bump that up to 2,500, go to 5,000. And some of the companies, you know, the bigger carriers started years ago going to a 1% deductible. So I mean, you have to think about that. So it's 1%, and then a lot of people don't even know that these days, that they have a 1% deductible. So on a $100,000 house, you have $1,000. On $1 million house, you have 10,000. So I mean, it's you need to see what is going on, because companies are definitely going to that type of a deductible and trying to take away the smaller claims and letting people pay the little stuff.
You know, we have several insurance companies that are headquartered here in Central Illinois, and so that means all complaints are processed here. So if they're not located here, we don't process the complaints here. So one of the patterns that I see in Central Illinois for complaints is people assume that they have a homeowner's insurance policy, and then an event happens that the thing should be covered, no questions asked. Can you talk to how maybe that mentality is old or out of date,
No,
and why you think
It's a very fair. It's a very fair question, and it's what even as agents we struggle with, because the consumer really doesn't know a lot about their insurance. And so when they come in and they sit down and talk with us, and we try to go through as many questions as we can, the reality is they just assume whatever happens at their house is going to be covered. And if you've looked at your insurance policy, it's a stack of papers this thick with
codes.
they give coverage, they take coverage away, they exclude something, but then they buy it back. I mean, and it really is. It's a very hard thing to try to figure that side of it out from that standpoint.
Yeah, the important thing of having a good agent that you can ask those questions and know the answers to. But I think one of the things that most people are confused about is depreciation value when it comes to getting a check or getting something repaired, whether it's auto or home. Can you talk about the difference between actual cost value and replacement cost value?
Sure. So the auto side, I'm going to make it kind of simple, because it really, most of the companies are going to use like NADA Blue Book, you know, or Kelly Blue Book, but it's really NADA, where they're going to look at a vehicle, they're going to price it out, and it's going to be very close on, if you're totaling a vehicle, what that cost is. And then obviously, hopefully, if it can be repaired, it can be repaired. On the homeowner side, replacement cost versus actual cash value, it's always, and a lot of times I use this to explain contents. It makes it simple. You know, insurance is to put you back in the same financial position, no better, no worse. And reality is, people think they should be better off, and that's the part that they're always trying. Oh, can you bury my deductible? Can you figure that? I mean, that's part of the process that people try. So the reality is that, so let's just take in a loss. Okay, they're supposed to put you back. So if you have, let's say, a kitchen table that you bought for $1,000, you bought that for $1,000. Then the loss happens, fire happens, kitchen table's burned up. At the time, that kitchen table is 5 years old. So let's just say it's now only worth $500, okay? Their obligation, they will pay you right then when you tell them you've lost this kitchen table and it's 5 years old, they're going to pay you the $500. That's the actual cash value. That is right now what it is worth. That is what they owe you. That's how much you're losing is a 5-year-old table. Then if you have replacement costs in your policy, then it's your obligation. You go out, and now if it costs $1,500 to replace that table because it's 5 years old and the kind quality is $1,500, then once you show them the receipt, then they will pay you the additional $1,000 to pay for it. And so that's a hard thing in major losses, where people are first of all, they don't even know the stuff they have. I mean, I always say it all the time, you should videotape your house once a year and just should walk around and then put that off site so that you have documentation, because you forget. As having gone through it, my son had a recent apartment fire, and I realized Lululemon, how many pairs of Lululemon shorts you could buy, and how expensive that stuff could be. But the reality is he might not choose to replace all those. So they're going to just pay him, if he only replaces 5 pairs, then he'll get paid. The other ones, he's just going to get his actual cash value, and he can go do whatever he wants with that money.
So I think there's a piece there that most people don't realize is you're going to have some out-of-pocket expense. I think people are expecting the check, so then you can go buy the kitchen table.
Correct.
But you can't buy the kitchen table because you don't have the 1,500, the difference.
And that's the process where, depending on the company, I mean, how many adjusters they have, what's going on, is if you, let's just say you get that list itemized real quickly, you get that over to them, they will write you the check for the actual cash value that will at least give you cash to start the process. Some companies are also, they'll give you money up front and they know there's a loss and they know they're going to pay out. Some companies will do that, some don't. Again, it's all about the policy, the forms, and how companies handle those type of things. But that can be a tough part, is because it's not a fast process. And everybody's financial situation is different. That can make it difficult of having to maybe find a new place to live at the same time as they try to buy new stuff and keep their kids in school and going to dance. And, it's a horrible experience.
What is your financial advice to people? I mean, like keep your deductible in the savings account, or what do you recommend?
I mean, obviously you need to know what your deductible is going to be and what it's going to cost you. So from that standpoint, you always should have, your emergency fund, as they say, available. But, that's a good way to save the money, though, is upping those deductibles on both your, because I would tell you, don't ever turn in a claim $1,000, $1,500. I would never, ever turn in a claim, because insurance companies genuinely don't see their coverage as a maintenance program. Ongoing maintenance is what you're supposed to do and take care of. I think sometimes they market that, that they say, oh, we'll cover this. And it's like, but they don't want little claims. They're there for the big claim. And that's the reality. And so that's one mistake that I see a lot of people make, is when they don't have an agent to call and talk to. And even some of the big carriers push their people to a call center. The big one is hail damage and roofs. Okay. So again, it goes back to a policy. All right. Does the company have total replacement costs on roofs, or do they have a sliding scale? In the last 5 years, companies have started to depreciate roofs and literally lay out. I mean, I know a lot of the big companies have a scale that if your roof is 2 years old and it's asphalt shingles, they're going to pay 85%. Go 10 years, 65. I mean, so those are where other companies at year 27, they still might pay replacement costs. They might replace your entire roof that needs to be replaced anyways, depending on what your policy has. And
So
that's
you're saying even if you had replacement cost coverage, there's the sliding scale aspect to it?
depending on the company. Yeah, a lot of them on roofs are now going to a sliding scale.
Oh,
So some companies offer replacement costs, some offer the sliding scale. So then
so important.
what happens, right, because what happens is a person who might be tight financially, okay, so let's say the company's only going to pay out 50% of that roof, okay, it's a $20,000 roof. They're going to pay you $10,000 minus your $1,000 deductible, you're going to get $9,000. You still have to come up with $11,000 to pay to get the roof done. And by the way, since you reported a claim and you've been paid by the insurance company, if you do not fix that roof by the time of your renewal next year, they will be non-renewing your policy and they will not stay on it because they've already paid out a roof. You have chose not to fix it. So in turn, they don't want the exposure because they don't want to have to pay out again on that thing. So and that's a big one these days on the roof side of it, because of the sliding scale, because then people don't have the cash laying around to offset the difference.
Yeah.
So,
Yeah.
I mean, and obviously it's
Is there a rider or something that can be added to?
well, it just depends. I mean, sometimes you can buy full replacement if it's offered. But a lot of the companies now will not offer it on a roof that's 5 years, 10 years
I
old.
see.
It's not even going to be offered because they don't want to be paying for a roof that should really be replaced. But I mean, I had a guy the other day came in because what happens is there's what's called a comprehensive loss underwriting exchange, a CLUE report. All personal lines companies subscribe to it. Every time you have a car accident or a homeowner's claim, it goes onto the CLUE report. So when we're rating you, we have to look at your CLUE report. We have to find out what the losses were. Well, I had an individual that had a 27-year-old roof, had reported a claim to a big carrier. They denied it, and they rightfully so, because it really wasn't hail damage. But that claim was now out there on the Clue report, and you had an old roof. So now when he came to me, I said, well, it was a roof that they had hail damage, but not enough to pay the claim, and the roof is old. And so in turn, now I don't even have a company that will insure them. And so they either have to replace their roof or they just stay with where they're at. It's because they have not been canceled, but they can't move. I don't have a single carrier that will take them because they have a roof claim without a repair.
So even though it wasn't approved, the claim counts against you.
Correct.
Wow.
Correct. Yeah, it's a tough. But again, those are the conversations that I feel what we do different is you call us and I say, have you had a contractor come out? Because a lot of our companies, and we know, like certain companies, it's going to be 10 hits per square of shingles. So I mean, there's stuff behind it. So we're trying to advise you before we go and report a claim. Let's check and make sure roofers come out and they've co-signed that this is going to be. But then I also go through, hey, by the way, we know this is the year, this is what your depreciation is going to be. So just know if you report this claim and it costs $20,000 to replace, you're going to have 11 out of your pocket. So again, it's talking through that beforehand because they're like, well, I can't afford it. And I'm like, well, that's what's going to happen. I'm just telling you the facts. You can choose to go whichever direction you want to go.
Yeah, I think that's the secret sauce to all of this is having a great agent that you can talk to and not get the runaround and unanswered questions and assumptions and all the things that really frustrate.
Yeah,
people.
I mean, and I see it all the time, and it's sad because you make an assumption, you buy a homeowner's policy, everything's covered. But people don't realize there's so many exclusions or limitations. It's like jewelry. I mean, people don't understand that most jewelry is going to be capped at like $2,500 is the most. So I mean, if you have an expensive ring, you have to get an appraisal. You have to bring that in. We have to schedule that. We have to do it differently. And so I mean, it's all that kind of stuff. There's limitations, guns, fine arts. I mean, it's like, do you have a tractor, a mowing tractor that goes off site? Well, that it changes when it leaves your premise. I mean, there's just a lot of things. And it's really just talking through, hey, we inherited some land out here that's out there, vacant land. Okay, is that covering my homeowners if someone trespasses on that land and gets hurt? I mean, it's talking through with your agent the exposures that you think you might have. And that's our job is to sit down and say, can we provide coverage at what amount? Because everything with insurance is how much risk you want to take on yourself. Because if you don't have a mortgage, you don't have to insure your house. So I mean, if you think I don't want to insure the house, you don't have to. If you don't have a mortgage, now if you have a mortgage, the bank's going to make you because they want to cover their loan. Now, car insurance, you have to have liability in the state of Illinois. It's a requirement, but it is not a requirement to have homeowners coverage. And the other part that homeowners, that people always forget, is you have the structure, even renters or owners. But the other biggest piece in the litigious environment we live is you have your liability piece. So it's if you get sued personally, your dog bites somebody, that person gets hurt. They sue you because their child has been bitten by your dog. That's your liability that comes off your homeowners and your renters. So I mean, those are important things. You know, I say all the time, the more assets you have, the more you need to be talking about liability versus what your car's worth or what your house worth, because they can take all your assets if you get yourself in a bad accident and you don't have enough liability coverage from that standpoint.
My goodness. It's certainly worth a conversation. So if you're not talking to your agent, make the phone call right now. If you don't have one, check out Fortner Insurance right here in Peoria Heights. Longtime agent, obviously knows it inside and out. And I hope you learned something from this episode. The jingle that you're about to hear was made in-house by Andrew Smith. Thanks for watching.
All Good Things with BBB helps you be a better business.